session we shall look at analysing the entries for a number of common transactions and the preparation of the journal entry for the transaction. So let's get started right away. We have already learned there are some simple rules for double entry, most important of which is that the debits must equal the credits. To analyse most transactions we need to try and determine the type of transaction. There are only a few of these. You should also try and remember the natural balances for the groups of accounts. We are going to focus on the most common transactions. We shall start by looking at the transaction for the initial investment, since this will take place for all small businesses. The sum of $50,000 is invested by Ali to start his landscape service. Ali has been saving to start his business, but he must keep the accounts and treat the business as a separate entity. The first step will always be to identify the accounts involved. For this transaction, they are the cash account in which $50,000 is placed and the owner's equity account where Ali's interest is recorded. Cash is an asset for the business, and to increase an asset account we always debit the account. The equity is Ali's interest in the business. To increase an equity account we credit the account. Look at the journal entry here. It really is very simple. Debit the cash account with $50,000, credit the equity account with $50,000. Now let's consider another transaction, taking out a loan to provide more money for the business. He agrees a loan for $40,000 from his bank. He could have used other providers, but the banks are usually the ones offering the best interest rates. We start in the same way, identifying the accounts. Ali will receive cash from the bank, so the cash account must be one account. Ali will owe the bank money, so a loan account is needed. The cash account, which is an asset account, will increase. To increase an asset account, we debit the account. The loan account is a liability account. To increase a liability account, we credit the account. So the entry is simple. Debit cash with $45,000 and credit loan with $45,000. From time to time, Ali will be expected to make repayments for the loan. Let's look at a simple repayment. He repays $1,000 of the principal. We shall consider in the next session how we make entries for interest due, but for now we're just concerned that the repayment is part of the principal. The two accounts will be the loan account and the cash account. The loan account is a liability account and the repayment will reduce the liability. To reduce the liability we shall debit the account. The cash account is an asset account. We have reduced the asset by making the repayment. To reduce an asset we credit the account. So debit the loan with $1,000, credit cash with $1,000. Most businesses require equipment to carry out their work. Let's look at the entry made when he purchases an asset, a lawnmower for $2,000 for which he pays for using cash. The two accounts that are involved are both asset accounts. They are an equipment account and the cash account. The equipment account gains the value of the lawnmower. To increase the asset account, we debit the account. The cash account is reduced by $2,000. To reduce an asset account, we credit the account. So, debit equipment with $2,000, credit cash with $2,000. Ali will need other materials for his business. Those that will be used and consumed as a part of the business activity are referred to as inventory. He purchases pesticides and herbicides for $300, not the most ecologically friendly, but that doesn't concern us here. His account for materials to be used will be the inventory account, and his payment is to be made from the cash account. The inventory account is an asset account, and to increase this account we debit the account. The cash account is reduced, and so we credit this to reduce the asset. We often say there has been a transfer of assets for this transaction. So debit inventory with $300, credit cash with $300. Sometimes Ali will purchase materials on credit. He purchases $800 of fertilizer on credit. The accounts he will use are inventory and accounts payable. accounts payable will record what he owes. It is a liability account. To increase the asset account, it will be debited. To increase the liability account will be a credit. So debit inventory with $800, credit accounts payable with $800. Eventually, Ali will be required to pay for his purchases on credit. The accounts involved will be the accounts payable and the cash account. His payment will reduce his liability. To reduce the liability, we debit the account. His payment will reduce the asset of cash. To reduce an asset account, we credit the account. So, debit accounts payable with $800, credit cash with $800. The purpose of his business is to make money, and to do this he needs to make sales. Ali makes a cash sale when he provides landscape services and receives $750. The money he receives is an asset that will be paid into the cash account. To increase the asset, we debit the account. The sale that he makes has increased revenues. To increase a revenue account, we credit the account. So debit cash with $750, credit sales with $750. Some customers will have an agreement with him to pay at a later date. These are the customers to whom he will make credit sales. Ali makes a credit sale to Gilbert for $2,300. He will record the asset of $2,300 that he is owed in an asset account called accounts receivable. To increase this asset account, he will debit the account. He will record the sale as revenue. To increase a revenue account, he will credit the account. So debit accounts receivable with $2,300, credit sales with $2,300. When Ali receives his money from Gilbert, this transaction will be entered. The money received is an asset and the account used will be the cash account. To increase the asset account, we debit it. The money will reduce the amount he is owed, so the asset account of accounts receivable is reduced. To reduce an asset account, we credit to the account. So credit cash with $2,300, credit accounts receivable with $2,300. Finally, there are other costs of Ali running his business which are recorded in expense accounts. Ali pays a water utilities bill using cash. The expense of utilities is increased. To increase an expense account, we debit the account. The asset of cash is decreased. To decrease an asset account, we credit the account. So, debit utilities expense with $300, credit cash with $300. This ends our third session on double entry. Thank you for watching and listening.